Well, friends, Assalamu alaikum. Welcome back. So, the second analysis in the financial statements analysis is usually known as the vertical analysis, and also it is known as the common size financial statements, right? Why we say it's a common size financial statements? Because what we do is we reduce the financial statements to percentages. So, the entire income statement will become in the form of percentages. The entire balance sheet will become form of percentages, right? And these percentages will not be in terms of the some base year or comparative year. It will be percentages within the particular year. So we see how we develop. So that's why we can then easily compare the financial statement of one company with the financial statement of another company, although the two companies may be of different sizes, but since their numbers have been reduced to 100 and the percentages, so we can easily compare. So on an income statement, what we do is we keep net sales as 100, right? So you can see over here that we keep net sales, right? This net sales as 100%, and then all the other items are actually calculated as a percentage of this net sales. So we know net sales minus all expenses becomes the net profit. So it means all expenses plus net profit is equal to net sales. So this way net sales will be broken down into how much of it is cost of goods sold, how much of it in terms of percentages, operating expense, A expense, B expense, C expense, X expense, Y expense, and how much is the profit. So maybe if net sales is 100%, then if all the expenses taken together are 84%, then the profit should be 16%, things like that. So this is how the common size income statement is worked out. For the balance sheet, we keep the total assets as 100%, right? So first of all, we take total assets, and of course, when total assets is on the left hand side of the account equation, then corresponding on the right hand side, we have the total liabilities and equities, so that's 100%. And then all the other items are actually shown as a breakup of these total assets or total liabilities. So we say that our accounting equation is now shown in terms of 100. Say what is the breakup of current assets, non-current assets, property, plant and equipment, account receivable, inventory in terms of 100. So this is very useful because it shows you the composition of different assets, composition of different liabilities in your total net worth, or the composition of different expenses and different revenues in your total sales. So this is very useful, and especially they are very useful when comparing different firms of different sizes in the same industry. So we see how it works. So let's say this is the consolidated statement of financial positions. Let me change it to the laser pointer. Okay. So this is the balance sheet. So for balance sheet, we keep the total asset as 100%. So we write 100% over here straight away. Again, the total liabilities. This is the 2019 total assets. And we then divide this current assets by total assets. So the percentage of the current asset is there, of plant asset is there, intangible asset is there. So we can see from moving from 2019 to 2020 that our composition of plant assets has increased. Previously, the plant asset was 39.7%, now they are 43.6%. Whereas our composition of the current assets has relatively decreased, and marginally intangible assets have also been decreased. Right? So this kind of analysis is done with this sort of vertical analysis or common size statements. So this is on the equity side. So for example, again, the total liabilities and equities are taken at 100%. And then every item, so you see, is actually shown as a percentages. So the equity is total 54.7%. So the liabilities are 45.3% because this 45.3 plus 54.7 makes up 100%. And you can also see that individual equity items, so the share capital and individual non-current liabilities and current liabilities, how they have changed. So for example, you can see that the equity as a total is increased from 49.8%, that is almost 50%, to 55%. So 5% almost increase. And this increase is mainly attributable to actually this retained earnings, whereas only in terms of the percentages, the share capital proportion has decreased, but in terms of absolute terms, it has slightly increased. On the other hand, the liabilities have also decreased, the non-current liabilities, but the current liabilities have also decreased. So this is how this kind of financial statement actually help us evaluate the composition of different items within the statement of financial position. Moving on to the income statement. So you see, we keep net sales. So net sale is over here. This net sale is taken as 100%, not gross sales, right? Net sales. So the gross sales is sales revenue. So this now more than 100%. So there are sales returns and allowances and discounts. So we deduct them, and then the net sales is 100%. So we show them, of course, 106% or 108%, whatever it works out to be. So this also gives us a very useful information as to how much of gross sales have been returned or are allowed as discount or allowed as allowances. So net sales is 100%, and then every other item is actually shown as a percentage of net sales. So we divide this cost of goods sold with this net sales, we divide this operating expense, selling expense with net sales, and we see that the profit is actually in 2019 it was 11.4%, and in 2020 it is 12.6%, uh, although the other compositions have also changed. So uh, regardless of whether the profit is increased or decreased, this will remain 100%, right? Whether sales have increased or decreased, sales will remain 100%. So we are not actually comparing the increase or decrease between the 2 years. What we are actually just comparing the composition. So the composition of cost of goods sold was 61%, whereas last year it was 62%. This year it is 61%. So this is a good thing, right? That out of 100% of sales, our relative proportion of cost of goods sold is decreased. Our relative proportion of selling expense has slightly increased, and administrative expense is again slightly decreased. And this is how 21.9%. So for example, another sort of comparison that we can make is that another company in the same industry might have a net profit of 12.6% of sales, same profit, but maybe the cost of goods sold would be 40% and the selling expense would be say 50% or maybe 30% or 45%. So this is how we make comparison of the composition, that how these compositions are different. So calculation wise, I think it's not an issue. It's very straightforward, but we have to infer important meanings out of it. So for example, if the composition of inventories, see the balance sheet, composition of inventories have increased over here. This is just the current asset, but we can have the breakup of current assets. So if inventories have significantly increased, receivables have significantly increased in terms of percentages, composition percentage. Maybe by amount they would have decreased, but in terms of the composition of the 100%, they might have increased. So that can be actually alarming or signaling towards certain trends which have to be catered. Similarly, we can do it for other statements, but usually these are the two statements which are converted into common size statements. And now in the next video, we shall see the ratio analysis, which is the third tool in the financial statements.